Thank you for joining Market Insights. I'm Jack Thurman, president of BKD Wealth Advisors. Being ultra-conservative in today's market may seem gratifying now, but overly conservative investors may be risking a lot when it comes to their future. Today, I have asked Jeff Lehman, our Chief Investment Officer, to address some of the common questions we're receiving from our clients concerning investment strategies for our current economic and market environment. As a result of the extreme downturn in stocks in 2008 and early 2009, many investors concluded they couldn't afford to lose any more money. Therefore, some adopted extremely conservative investment strategies, focusing on bonds and short-term investments like bank CDs and treasury bills. Jeff, is this a wise approach for long-term investors?
Well, Jack, this approach does address investors' primary concern, which is that of losing money, or what we would call principal risk. But over time, there are other risks that are equally important for them to consider. For the conservative investors, those include purchasing power risk and interest rate risk.
Jeff, what is purchasing power risk, and why should investors today be interested in knowing about it?
Well, Jack, purchasing power risk, which is also known as inflation risk, describes the gradual erosion of portfolio value and income over time, even if principal amounts stay the same. So an investor could be focused on preserving their principal, but given that inflation rises, the cost of goods and services rise by about 3% per year historically, the value or the amount that those dollars will buy in the future will be less. So as an example, in the late 80s, the average home price in the U.S. was about $120,000. Today, it's closer to $200,000. A gallon of gas in the late 80s could be bought for about $1. Today, it's closer to $3 a gallon. So you can see that dollar of income doesn't buy near as much today as it did then. And we'll have the same impact 20 years from now. So this is a very serious consideration for those folks that are saving for retirement and looking to provide income.
Jeff, talk about interest rate risk. You would think as interest rates go up, that would be better for investors, but we're still talking about interest rate risk in this current environment. Give us an explanation of what ultra-conservative investors should be thinking about right now.
Well, you're right, Jack, in that rising interest rates can be good for some investors that are positioned in very short-term instruments where the rates reset very regularly and often. They'll gradually have an increase in their income stream when rates rise. Where interest rate risk really comes into play is with longer-term fixed income or bond instruments. So the relationship is this. When interest rates rise, the value of existing bond portfolios come down. Based on the maturity range of the bond portfolio, that can be minor or it can be more severe. For an investor, for instance, that has a 10-year average maturity in their bond portfolio, for every 1% rise in interest rates, their portfolio will come down by 10%. So the risk that they were trying to avoid in the stock market, which is principal risk, can perpetuate itself once again.
So it seems, Jeff, there's no way to avoid risk. We've talked about stock market risk that we all experienced in 2008 and 2009. We've talked about purchasing power or inflation risk. We've talked about interest rate risk. How in the world does an ultra-conservative investor strategize or put together his portfolio going forward with all these risks surrounding them?
Well, there's a solution, Jack, that has worked very well over time. It just involves combining these more conservative investments like CDs and bonds with investments that tend to allow for keeping up with inflation over time. And these are things like stocks and certain alternative investments. Even the most conservative investors will increase their chance of financial success by having a small portion of their portfolio invested in these more growth-oriented investments. That's the key, is balance in the portfolio. The right mix is really specific to the individual, and that's something they should discuss with their financial advisor.
So, Jeff, we've heard about tech bubbles, we've heard of real estate bubbles, and now we're hearing a little bit about a bond bubble. What does an ultra-conservative investor do in the midst of this to avoid that type of risk?
Well, Jack, it's true that bond prices have risen not just in the last few years, but over the last 25 or 30 years as interest rates have come down and those baby boomers seek income-producing investments. We don't really characterize what's going on in the bond market, though, as a bubble in the sense that these prices haven't climbed like they did with technology stocks or like they did with home prices. It's been much more of a gradual rise in price. We do think that there is some risk to principal in bonds currently, but we wouldn't characterize it as a bubble.
Thank you, Jeff. As market events occur, which impact our clients and raise common questions. We will continue to provide these informational broadcasts. For more information about BKD Wealth Advisors, please visit our website at bkdwealthadvisors.com. Thank you for joining us today.